Welcome everyone, and thank you for joining us for OMFIF's Fed Week. I'm John Orchard, OMFIF's CEO. You're in very good company. We've got 1,000 people registered to listen in over the week. There are lots of central banks from all over the world, commercial banks as well, regulators, deposit insurance schemes, public and private sector investors, and asset managers, among others, all joining us over the next few days. So you're in good company. Perhaps this isn't a surprise as the Federal Reserve starts to think out loud about tightening monetary policy, and indeed last week slightly raised the overnight reverse repo rate. Judging by our OMFIF panel after the FOMC last week, we'll talk about that in a moment, and indeed pretty much all of our sessions in all regions, that there is no clear consensus on whether incoming inflation from the COVID recovery should be looked through or not. We'll no doubt be talking about that. But also other key themes such as central bank digital currency and the role of central banks in sustainability and build back better agendas. We've got an excellent group to do that with. We're going to hear from 5 regional Federal Reserve presidents and CEOs this week: Patrick Harker from Philadelphia, Raphael Bostic from Atlanta, Eric Rosengren from Boston, Robert Kaplan from Dallas, and James Bullard from the St. Louis Federal Reserve. We also have the Congressman Bill Foster from the House Committee on Financial Services on the agenda too. We'll be feeding in audience questions in these sessions too, so do please send us those using the chat function as we go. We're very keen to integrate them into the flow of conversation, so do send them in. I'll give you a brief overview of the week's agenda in a moment, but first I'd like to introduce Patrick Harker for some preliminary remarks. Patrick, who's had an illustrious career in academia, specializing in business, management and operations, took up his post as the 11th president of the Federal Reserve Bank of Philadelphia in 2015. Patrick, welcome. Thank you for joining us, and over to you for your introductory remarks.
Well, thank you, John, and to everyone, good morning, good afternoon, or good evening. I know we're joined by quite an international audience today, so maybe it's just safer to say hello. So really, on behalf of OMFIF and the Philadelphia Federal Reserve, I am delighted to welcome you to Fed Week. And we are all in for a treat. A week of discussions covering the macroeconomic outlook, AI and machine learning, digital currency, equitable and sustainable growth, and financial stability. Now, you may know that our original plan was to hold this week of talks at our bank in Philadelphia. And while by holding this event virtually, I know we're missing out on some fruitful hallway conversations, not to mention some tasty snacks, it is, I think, terrific that we were able to convene such a wide-ranging group with just the click of a few buttons. So again, I want to thank you all for joining us, and thanks as well to all of our panelists, who I know firsthand have very busy schedules, and also, of course, to our partners at OMFIF. This morning, you'll be hearing from 2 of my Fed president colleagues, Jim Bullard, President and CEO of the Federal Reserve Bank of St. Louis, and Robert Kaplan, President and CEO of the Federal Reserve Bank of Dallas. They will be discussing their macroeconomic outlooks. But before we get to that, let me turn things back over to John. Again, thanks for being here. I'll see you later in the week. Enjoy the program.
Thank you very much, Patrick, and to you and the team at Philadelphia as our virtual co-host today. So looking forward to being physically in the building again. We hope next year. We'll turn over to my colleague Mark Sobel, our US chair, in a moment to open the first session, but first I'll give you a quick tour of what we'll be discussing this week. Today we'll be looking at the macroeconomic outlook, discussing the FOMC and also the Fed's dual mandate. Lots to talk about there, with markets offering a little amuse-bouche perhaps on a potential taper tantrum last week amid perky employment indicators, which Jay Powell has drawn attention to, albeit he seems pleased about those with his modified mandate. All the while, inflation concerns at the moment seem to be being played down. We'll explore all of that. On Tuesday, we're looking at the role and nature of artificial intelligence in markets and its socio-economic impact, whether there is unconscious bias in those systems, and we'll be looking at regulation as well. On Wednesday, we'll be hearing how Congress is looking at central bank digital currency and the work that the Fed is doing to test its practical use. OMFIV has spent a lot of time on this theme over the last year or so, and I think it's fair to say that there are lots of fundamental issues still unresolved there, broadly where they were last year, notwithstanding huge amounts of development on the technological front and the preparation front. So we'll look at that on Wednesday. On Thursday, we're joined again by Patrick Harker and also Raphael Bostic to look at the Build Back Better agenda, as Patrick just mentioned. We'll explore how the three crises, health, economic and social, are converging into a key moment in American socioeconomic development. And we'll look at the effect COVID has had on the most economically vulnerable. On Friday, Mark Sobel will be back discussing the Fed's financial stability report, how the US financial system weathered the pandemic, and we'll revisit the topic of CBDCs with the Boston Fed and President Rosengren. So do log in for all of those. We're looking forward to having you with us for that. Mark, our US chair, is, as our regulars know, a former US Treasury official with a long career representing the US in international forums such as the IMF, G7, G20. Mark, I might ask you what you made of the meeting in Cornwall in a moment. So thank you for helping Mark put all this together this week. Before we kick off, though, I was interested to get your take briefly on the FOMC discussion that you chaired last week with Christopher Smart and Steve Cacchetti. The first time in years, I got the impressions we were mentioning a while ago that monetary policy, including the future path of QE, isn't entirely predictable, albeit that might be a healthy discipline for financial markets, I'd argue. What's your take, Mark, on the immediate response to last week's meeting based on what you heard in that meeting and indeed all the meetings that you chair for us? What's your take at the moment, Mark?
Well, thank you. Pleased to be here. We had a good discussion with Steve Cacchetti, who's a well-known American monetary policy scholar, and Christopher Smart of Barings. I think that our discussion reflected many of the cross currents that we see in the markets, in the public discussion, and frankly, what I expect to hear today from Robert Kaplan and Jim Bullard, and I'm deeply looking forward to that. If I were to give you just a thumbnail sketch of what I think were some of the key points from our discussion, the first was a bit of a debate about how to characterize last week's FOMC, whether it should be seen as hawkish insofar as the data and the dot plots were seen as substantially changed, and whether it sent the message of tightening sooner rather than later, versus a view that inevitably we had to face the beginning of a transition towards normalization, given that the degree of accommodation we have in the United States is not sustainable, particularly as an economy rebounds. There was some questioning also in that regard, and this is a theme one hears increasingly in markets and analysts, is whether the FOMC's tolerance for an overshoot might not be as great as originally thought, given flexible average inflation targeting. Another key takeaway was confusion and uncertainty about the economic situation, particularly labor markets and inflation. In a way, confusion was greater for labor markets, I almost thought. There were comparisons of seasonally adjusted data versus non-seasonally adjusted data, questions about mismatches, how quick the uptake would be. On inflation, observation that the Fed's inflation estimate in the summary of economic projections suggested that the largely transitory part of the inflation hump was over or would be receding, and whether there might be too much optimism. At the same time, while the inflation rates would be higher than originally expected a few months ago, I think there was still buy-in into the proposition that inflation rates would come down and were transitory in that sense, except unless aggregate demand so outstrips aggregate supply that there was a boost to inflation. And then more from Steve Cicchetti than Christopher, I would say, flagging concerns about asset bubbles, froth in markets, whether leverage, whether we had a good handle on leverage, particularly with regard to non-banks, and then some discussion of the increase in the 5 basis point increase in the repo rate and the interest rate on excess reserves, and wondering whether that was too generous and whether that would cause massive shifts out of paper or back to the Fed. So I think that is, in a nutshell, what was discussed. And I frankly think that's what we covered were the debates that are going on in the markets and the debates, the discussion we're going to have today.
Thank you, Mark. As I mentioned, there was a mini version of the taper tantrum, very mini version of the taper tantrum at the end of last week, but it seemed survivable. Do you think, and this will be guesswork on your behalf at the moment, do you think that the Fed will think that was a proportionate response that gives them confidence, perhaps, to gently carry on with the gradual tightening?
Well, you know, the short rates are anchored, the longer rates are not, but the longer rates have come down. They're down to 10-year in the 1.4 range. I think that as you said, we're in a transition period, but I think the Fed can feel fairly comfortable with its communications more or less at this point.
Good. Okay, I'm sure you'll explore that in a moment with your colleagues. Just very briefly, away from monetary policy onto political economy. I mentioned your role with the US Treasury, the G7, G20, IMF, and so forth. And you've written recently about the flawed but useful utility of the G7 for OMFIF. That's the most read thing with us so far this month. So well done on that. What would be your immediate reflection on how the G7 went from the US's point of view?
Well, I think from the U.S. point of view, it went very, very well. It was the president's first foreign trip. I think he was able to make very convincingly and clearly the point that the U.S. has strong roots in multilateralism, and that this administration believes in the multilateral roots of America, that we're going to work with our allies. I think that had become in question in past years. And so from that standpoint, great success and great messaging for the administration. I think it's interesting that the seven, which, as you and I have discussed in the past, took a back seat after the global financial crisis. Remember, at the Pittsburgh summit, we said that the G20 is the premier international forum for cooperation. There seems to be shifting back towards the seven. I think that the last decade has witnessed huge changes in terms of how the G20 interacts. It's bulky. China and Russia are there. Some of the focus we now have is on cyber and money laundering, where people have a very different view of China and Russia and activities that diminish the scope for cooperation. And I think that by inviting a lot of additional players to, such as Australia and Korea, that the G7 was able to emphasize kind of a democratic front at the leaders level. So, and the G7 did make progress on tax and issues, the international tax issues. So, good progress, but it's a messy world. The seven don't have the clout to run it. The G20 is bulky, and so I think there's also going to have to be a lot of what I would call variable geometry, where you have shifting coalitions.
And of course, Germany very well. We've seen today remarks in the FT from Laschet, probably the incoming Chancellor of Germany, saying, "Don't moan about Russia and China too much." So we'll see how that unfolds. So Mark, thank you very much for that helpful introduction, and over to you for your panel, which I'm sure will be excellent. Thank you very much for joining us, everyone, today. Over to you, Mark.
Well, thank you. So today I have the great honor of hosting OMFIF's opening Fed Week session on the economic outlook with Robert Kaplan and Jim Bullard. Robert Kaplan has been president of the Dallas Fed since 2015 after a distinguished career at Goldman Sachs and Harvard. Jim Bullard has been president and CEO of the St. Louis Fed since 2008, an institution he joined in 1990. Prolific author, as is Robert, and both are so well known, they need little further introduction. So I'm just going to raise a number of questions to set the table with our guests for the first half of the session. I'll then turn it over to the audience, which may submit questions via the Slido function, which is located to the right-hand side of your screen, I'm told. And you can also register for other OMFIF Fed Week events as well. So Jim and Rob, welcome, and let's dig in. So if it's said, may you live in interesting times, our hopes have been realized. A booming U.S. economy is perhaps throwing up more questions than answers about the outlook. The Fomc just met, a meeting including a summary of economic projections with interesting changes on the near-term inflation outlook and interest rate path. Perhaps both of you could briefly offer your take on the U.S. outlook and last week's FOMC. Let me start with Rob.
Hey, thank you, and it's great to be here with both of you. So our Dallas Fed forecast, ironically, did not change that dramatically since March, and for the last couple of months. We still expect GDP growth of approximately 6.5% for this year. At this point, we're probably a little bit shy of other more aggressive projections, but we're staying with a baseline of about 6.5%. We expect the unemployment rate is going to drift down toward the end of the year, approaching 4%, somewhere between 4.5%. The one change we made is further marking up our headline PCE estimate for this year. We're at 3.4%, but we were elevated in our SEP 3 months ago. And I think all you're seeing, and you're seeing it reflected since our December meeting, we've seen much more accelerated vaccinations than we would have expected here at the Dallas Fed at the start of the year, substantially more fiscal policy than we might have expected, and certainly much greater than the aftermath of the Great Recession. And I think as a result of those changes, we see greater mobility and engagement, and we've marked up since the start of the year our forecasts. And I think what you're seeing probably in the SEP is monetary policymakers simply reacting to the dramatically improved economic outlook and some of the changes I just referred to.
Thank you for that. Jim.
Thanks very much, and thanks for having me today. It's a pleasure to be here, as always. Yeah, I would go back to the December FOMC meeting. That was a period when the vaccines had just come online, and we were trying to make a forecast for how the economy would react. And if you look at the SEP in December, the median was about 4% growth. And I think importantly, 1.8% on inflation, core PCE core inflation, which is the one of the favorite measures of the committee. So that was a projection that indicated that yes, it would be a strong year in 2021. Yes, it would likely be a reopening, and yes, the vaccines would be successful. But in the last 6 months, it's all been much greater than that, as Rob was alluding to here. I think when we got to March, it was clearer that we were going to get the pandemic under control, but it's still, there was a lot of risk at that point at that meeting. And so I'm not sure you saw all of this reflected in the SEP at that point. So by the time we get to June here, this most recent meeting, the SEP median inflation rate now for core PCE inflation moved up to 3%. So now you got the growth rate instead of 4% for 2021 at 7%. So I think you really got a big upgrade. I think Rob mentioned, more fiscal policy than you would have anticipated at the December meeting. Although I did think there would be one bill at that point, but we could debate about that. But so I just think we're in a much stronger position with respect to reopening than we would have anticipated, and the inflation has come along with it. So I think the good news is that we announced a new framework. The chair gave a speech at Jackson Hole last year. The essence of that framework is that we would allow inflation to run above target for some time. It looks like we're going to achieve that. Headline PCE inflation projected by the committee to be 3.4% according to the median in 2021. Core PC inflation of 3%. So I think some of that will persist into 2022. I've got penciled in 2.5% core PC inflation for 2022. So if we really get that, then we'll have run inflation above target for some time. And then after that, we'll approach 2% inflation from the high side. And then if you average that across past years, you get something pretty close to 2% inflation. Now, this is a period of high volatility, as you outlined at the beginning, Mark. No one really knows how this is all going to unfold, but we have to be ready for the idea that there's upside risk to inflation, could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that, to be state contingent, to be nimble. Just as nimble coming out of the pandemic as I think we had to be going into the pandemic, when we made a lot of what now is looking like very good moves in March and April of last year. I think we have to be just as nimble on this side.
Well, thank you for that. Well, let's turn a bit then to labor markets and inflation, given the dual mandate, because as you suggested, labor markets and price trends are pretty confusing. So on labor markets, unemployment near 6%. It's much higher than NAIRU. U6 is 10%. Labor force participation is well down. The last two payroll figures were seen as short of expectations. So one conclusion might be that there's a lot of slack in the economy, but businesses are desperately looking for workers. Workers are upping wage demands. Job openings are at an all-time high. So Jim, I read recently a quote in the FT from you. I'm evolving towards a judgment where labor markets should be interpreted as fairly tight. And I've also recently seen a Dallas Fed blog, a very good one, which I think made the exact same point and went through some interesting data points. So let me start off with Jim, but what's going on with labor markets?
Yeah, it's a great question. Certainly, the anecdotal evidence is overwhelming that this is a very tight labor market. You're hearing all kinds of stories about trying to recruit workers through, say, one-time bonus payments, higher wages, better, more flexible working conditions, all kinds of things that are symptomatic of a very tight labor market. So I think one statistic that you can look at that's consistent with that is the unemployment to vacancies ratio, which is about a 1.1 right now. That means, approximately one job available for every officially unemployed worker. That sounds pretty good if you can just get them matched up. And I'm not sure they're matching up quite as fast as we might have thought, but that suggests that the situation that we're in. And just for comparison, after the global financial crisis, that number was a 6. So there were 6 unemployed workers for every job opening. And that only came down very slowly. So we're in a much different situation today coming out of this pandemic than we were after the global financial crisis. Also, I would say about labor markets that the extent of improvement has been dramatic. You had an official unemployment rate of 14.7%. Now we're down to 5.8. I expect lots of improvement in the months and quarters ahead. So I'm not really worried about the labor market side. And Chair Powell said this in the press conference last week, that he's anticipating, a very good labor market going forward because we've seen such great improvement, and you've got an economy growing at 7%, faster than China. That's all very promising. So the committee is only now starting to talk about tapering, and that will take some time to get that organized and get that up and running. And only talking about later in 2022 or 2023, and some members even later than that, talking about some kind of change in interest rate policy. So by the time we get to that point, it's pretty clear that we'll have a strong labor market no matter how you cut it. And so I'm not really worried about that side of the mandate here. We're going to give plenty of leeway for the labor market to continue to improve.
Rob, please.
Yeah. So building on what Jim said, in the research blog we wrote a couple of weeks ago, we noted that in excess of 2.5 million workers have self-identified since February of 2020 as being retired. And you got to remember that in the aftermath of the Great Recession, many older workers said, because of debt and loss of value in their homes, I'm going to have to extend my career, delay my retirement, and work longer. We go to the current situation. Home prices have appreciated. Household balance sheets, while not perfect, are in much better shape. And so we've had a number of some of the pent-up retirements from 18 and 19 have worked through to today, where we have sort of a catch up in retirements and probably some excess retirements, and people financially are in much better shape. So the jury's out on how many of those folks will decide in the future to unretire. And I would also note the record level of merger activity being driven by a number of factors, including loose financial conditions, is also accelerating that. And one of the things that happen out of these mergers is oftentimes the first thing they do is try to reduce workforce and offer buyouts to older workers. And so that's a loss of supply. Then we estimate another 1.5 million workers are staying at home as caregivers. Many of them are women with children. And so that's a big chunk out of the labor force. And we'll have to see how many of those workers come back. And then in addition, we still have the issue of fear of infection, lack of access to childcare, and then there's been much made as a piece of the puzzle, unemployment benefits, where if you make $12 to $15 an hour, the economics don't work so well versus unemployment benefits and coming back to work. And so we're wrestling with many supply issues. In the aftermath of the Great Recession, we were wrestling with a lack of demand. Here, demand appears from every measure very strong. And what we're seeing is supply constraints. And I would also note, while the reopening has increased demand for workers, we still haven't fully returned to as much in-person work as we will by the fall. Schools will be back in person in the fall. That'll help in many ways. And in addition, business travel and a lot of other activities, while leisure travel is up, business travel still lags far behind. So actually demand for workers could firm somewhat further. And so we've got a very unusual labor market and tracking supply and demand. And we're going to have to be patient and allow time for these matches to occur. One other element I'll mention, which concerns us here at the Dallas Fed, and we're seeing here, but we're seeing nationwide, is a loss of enrollment in skills training. We've had a dramatic drop in skills training, and that's very critical that we get back to skills training enrollment, because not only do we have difficulty finding workers at the low end, we also have difficulty finding skilled workers and middle skilled workers, and the skill training pipeline, having that restored is another necessary agreement that I think will help this supply demand balance improve as we go through the rest of this year and into next year.
Okay, well, thank you for that. Well, let's turn to prices, which are perhaps even more confusing for me, at least. So the Dallas Fed uses a trim mean price measure, which takes out the fat tails, and it's fairly quiescent, I would say. Market break-evens, quiescent. Analysts talk about slack, anchored expectations, temporary base effects, and supply disruptions. And we're always told, don't confuse general and relative price changes. So that's one side. On the other, core measures have been higher in recent months and perhaps expected. There's flexible and sticky prices, and we haven't seen the sticky prices adjust. Maybe they will. Particularly, there's discussion about rents, which have not been moving so much higher, but may start to catch up with home prices, which have been doing well, which is the other side. You know, I haven't ever heard the Fed define what is transitory or persistent. I presume your concern would be if you had overheating, boosting prices, or second round wage effects. Don Cohn, a brilliant man I had the pleasure of working with when I was at the Treasury, he at the Fed. He recently said the supply-demand balance may not correct as quickly as the Fed thinks. He thinks the fourth quarter will be key. So what should we be looking out for? When would higher prices no longer be transitory? And when is an overshoot no longer an overshoot, but something more pernicious?
All right, so let me just, you want me to go first? Or you want Jim?
I was going to turn to you. That's why I mentioned the Dallas trimmed mean at the beginning.
All right, so let me start. Let me talk about what we're seeing. And I've avoided, since this all got started, I probably stay away, and we stay away here at the Dallas Fed at this transitory versus persistent. And we tend to look more at what's going on as the cyclical elements and the more structural elements. And here's what we're seeing, and here's what we're hearing from contacts. We've been hearing it for a while. We just talked about supply demand elements in the labor force. Some of those are structural. The skill training issue I mentioned is a structural element. This issue of retirements is a little bit more structural. So we think the wage issues could be a little bit more persistent because they may be a little bit more structural. Secondly, on other supply demand imbalances for semiconductors and a whole range of materials, some of them we think will resolve themselves in the next 6 to 12 months. But again, some of them we think are likely to be more persistent, driven by a number of structural changes in the economy. One of them is the energy transition. There's going to be trillions of dollars spent over the next many years on electrification, smarter devices, systems that connect them. All these things are going to require not only more semiconductors, but a number of greater demands for raw materials. And what we're seeing in the energy sector as well as raw materials generally, is shareholders are putting a lot of pressure on these companies to return more capital in the form of dividends and share repurchase. And so what our forecast at the Dallas Fed is that headline inflation PCE will be approximately 2.4%, but we think the risks are to the upside. And on the Dallas Trim Mean, which you mentioned, so there's things the Dallas Trim Mean tells you, and there's certain things it doesn't tell you. When you have extreme price moves, as we've had, the Dallas Trim Mean X's those out, so it's been fairly muted through this year. Our forecast for the Dallas Trim Mean, though, is that we'll gravitate up to 2.4%, consistent with our headline PCE estimate. It'll gravitate up to 2.4% next year. Why is that? A lot of these individual items and these inflation pressures will bleed out into a broader range of items and will persist through 2022. So the issue for us at the Dallas Fed is not to fall intellectually in love with any one outcome or characterization, but to realize there's a range of outcomes. And I think this is where the Fed, I believe, as a central banker, we should be applying risk management approaches, understanding that there's some upside risk. On the other hand, the base effects will wear off. Some of this may settle down. And I've been more of a fan of doing some things maybe to take our foot gently off the accelerator sooner rather than later, so that we can manage these risks and we can avoid and make it more likely to avoid having to press the brakes down the road. So that would be my response to the range of issues we're seeing on prices.
Thank you, Jim.
Yeah, thanks. On the Dallas Fed Trim Mean, and I've been one to cite it at various points in the past, and I do think it's interesting that the Dallas Fed thinks it's going to increase in the future and catch up with core PCE inflation. But I would just say this, the committee has looked at which inflation measure it wants to focus on. The answer to that question is headline PCE inflation. And we've enshrined headline and core PCE inflation by putting it in the SEP. So from a credibility perspective, what we're saying is this is the measure that we want to stabilize. And so when we say we're going to hit 2%, it's going to be on these measures, and especially the headline measure. And I'm not a fan of telling people that some of the prices you have to pay are ones that we're going to throw out. So I think the only purpose of something like the Dallas Fed Trim Mean or the core PCE is to try to get a read shorter term on trends in inflation, but people actually have to pay the headline numbers, and you have to be sympathetic with them and understand that if you're in those markets, those are the prices you have to pay. So I think that we're in a new era where inflation is above target and is expected to be above target in 2021. There doesn't seem to be much doubt about that. It does look like core PC inflation, according to everybody, is going to be higher this year than anything we've experienced in the recent past. And the question is, how quickly will that dissipate? And does the committee have the right posture to do the risk management that Rob was talking about if we get higher inflation risk than we're anticipating? So, like I said, I've got inflation coming down to 2.4% in 2022. I know some, but I would just stress the SEP, even the SEP says 3% core PC inflation in 2021 and above 2% in subsequent years. It's just not as much above as I've got it, but that would be all consistent with the flexible average inflation targeting. I think the debate, and I think it's a healthy debate, is where does monetary policy have to be in order to get that outcome, that gentle glide back to 2%? And what does it mean for the committee to say above 2% for some time? What's the time frame for that, and what's the magnitude of that. So I think that's a healthy debate to have. But I think it's all consistent with what we said we would do, which is have flexible average inflation targeting. We would get inflation above 2% and glide down to 2% from the high side. That's going to cement longer run inflation expectations at 2% and get to a better equilibrium for the U.S. economy.
Thank you. So since we've mentioned prices and we've mentioned labor markets, let me now turn that into taper, given that the Fed has said it will continue its assets purchases till substantial further progress has been made towards those goals. I think Randy Quarles said at a recent event, he's a wonderful gentleman, one of my former bosses and favorites. He said that in terms of price stability, we were there, but not on maximum employment. Do you agree? And then just two other questions. One, two others on this theme. One is whether tapering should start with agencies given the hot national housing market. This is the question that many discuss. And then already from the audience, several questions are coming in that basically ask you if the FOMC intended that markets focus on the dot plots rather than the taper signal last week. So Jim.
Yeah, on tapering, I think the chair said at the press conference that he was going to retire the phrase talking about tapering. So I think the debate is open, and I think it's appropriate. I didn't want to open the debate until the pandemic was more clearly under control, but I think we're at that point now. I know from previous debates about this that it has there are many parameters that have to be set. It's kind of complicated. You've got treasuries versus MBS, you've got when to start, you've got the pace of tapering, and you've got the degree of state contingency. How would you speed it up? Would you slow it down or not? Are you going to be on automatic pilot? And I guess my comment on this is that I don't think that this is an environment where you can just go on automatic pilot. You've got too much going on. There's a lot of volatility in the macroeconomic data. So we're probably going to have to be a little bit more ready than we were in 2014 to possibly make adjustments to our taper strategy. So all of that has to be debated. The chair has to set up somehow herd the cats and get the debate going. I think it'll be a healthy debate. It's a good debate. We've done it before, and we did it ultimately in 2014. We did it without any problems. So I think it can be done, and we're doing it in an environment of a very strong economy, 7% real GDP growth this year. That's something you don't see in the U.S. Very often, and very strong above potential GDP growth in 2022. So it's not like we're in a situation where the economy is exceptionally weak and we're wondering what to do here. We're coming from a position of strength. On the MBS, I think it is a legitimate debate and an important point. Frankly, I think going into the crisis here, we expected to see problems in the housing market, maybe echoes of the global financial crisis. This is March and April of 2020. None of that materialized, and in fact, the housing market went the other way. It boomed, partly fed by people wanting to buy houses and transition away from commute type work arrangements. And that has persisted right up until today, and really has some people talking even about a housing bubble. So I think there's a good question there about whether it's time to retire our intervention in the MBS market. And Mark, you'd be a good one to answer this. Some people say that treasuries and MBS are pretty much the same thing anyway, and so you might as well not worry about trying to draw distinctions here, but so I don't know where that debate is going to come out, but I think it's a very legitimate debate to have.
Thank you. I still remember Hank Paulson discussing that little point there about the equivalence between the two. But Rob, please.
Yeah, I agree that now allowing a open debate about adjusting our purchases and all the elements with that, when we might start, the pace and all the other elements, I think it's a healthy thing. I have a lot of confidence in this FOMC group, our colleagues around the table. Then when we have an open debate, we exchange views, and we hash things out. We've got the ability to come to good decisions, and I'm optimistic that we will in this case also. But I think the key is being able to have the discussion, have the debate, and I think that we're doing that is very healthy. I would say Jim mentioned a little bit about the Great Recession. Coming out of the Great Recession, as I mentioned earlier, the big challenge was lack of demand. And in that regard, the purchases that were put in place, QE, were intended to spur more demand. And at least for me, I thought that made sense. We could debate the tactics, but it made sense. And in 20 and 21, when we had a lockdown, we didn't know how things were going to recover. I also think these purchases had their place and made sense. It now, though, it's clear we're weathering the pandemic and we're moving forward. The issues seem to be less with lack of demand. I think we have very strong demand. A lot of it has to do with very strong fiscal policy. The issues are more with supply and supply-demand imbalances. Purchases of treasuries and mortgage-backed securities are probably not well designed to deal with supply issues. They're much better designed to deal with demand issues. And when you talk about the housing market, one, we're seeing prices historically elevated. Number two, we're also hearing increased anecdotes. And we talk to real estate participants broadly, including brokers in communities. We talk to heads of Head Start, community leaders. And what we're seeing is more often than not these days, the winning bidder in many of these house auctions sometimes is not a family. It's a post office box in Delaware, which is an investor who's never seen the house, wants the house furnished, and is going to buy it for investment purposes and re-rent it. So we're seeing increasingly single family buyers are getting squeezed out of the market. And we're also seeing in our district in at-risk communities with a lag, you're going to see an increase in rents, property taxes, and other burdens, particularly on those who are least able to tolerate it, at-risk communities. So we've been talking here, and I've been talking about the fact that at this stage, we're questioning whether the housing market really needs this Fed support of $40 billion a month, and option adjusted spreads being not historically low and sometimes negative. And are there unintended side effects and unintended consequences of these purchases? For myself, I think would be healthier, again, as we're making progress in weathering the pandemic and achieving our goals, to start adjusting these purchases, treasuries and mortgage-backed securities, sooner rather than later. And I think it may actually increase the likelihood that we sustainably achieve our dual mandate objectives. The timing of tapering, last comment, has an impact on what we may do down the road. And maybe in a way people might surprise people in that if you wait too long to taper and you have increasing buildup and excesses and balances, for us at the Dallas Fed, our own analysis is it may make it more likely that you need to take additional actions down the road that you would prefer not to take. I would rather see us act sooner rather than later on asset purchases. And then we'll make decisions, as Jim said, down the road in 22 and beyond about what additional steps are necessary. But I think the issue on the table today and in the near term is the timing of adjustment of these purchases.
Okay, well, thank you. Let's turn to flexible average inflation targeting, getting a few questions in on that. The framework was designed for a low inflation environment, in my view. Bill Dudley, somebody you know, recently expressed concern that the Fed may react too late to an overshoot that takes prices above 2%, and then he'll get behind the curve given lags. Others, Martin Wolf in the FT, echoed this sentiment. I guess Larry Summers has as well. And then in the last few days, I've seen market commentary that some have said that in the wake of the FOMC that the dots showed maybe a limited tolerance for an overshoot, or a more limited tolerance than might have been perceived earlier with the articulation of the flexible average inflationary framework. So let me ask you for your thoughts, and let me start with Rob this time.
Yeah, so I am a strong supporter of the framework, and I believe the framework is workable. I think the debate is not about the framework. It's about how we execute the framework. The framework says that we want to average inflation at approximately 2%, that we're willing to have a moderate overshoot of that 2% for some time in the service of achieving 2% average. And we have a responsibility based on that framework to anchor inflation at 2%. I think some of the debate is about then how do we execute that framework? And for me, this gets into risk management and tolerance for risk. I'm committed to see us anchor inflation expectations at 2%, but I also want to see us exercise risk management to moderate the tail risk to the upside. And in that regard, again, there's nothing in the framework about asset purchases, and I think moderating those sooner rather than later, I think may actually increase the likelihood we're able to achieve the objectives of the framework on inflation. And I would say a second issue, framework doesn't talk about where we should set rates. It basically says we're going to be less preemptive and anticipating inflation in service of having more inclusive and may be able to get to lower levels of unemployment. In that regard, again, I think it doesn't say you need to keep rates at zero. For me, my interpretation, it means you should be highly accommodative. And again, this gets back to, I think if you drive a little slower, maybe go 65 miles an hour, I think we may, versus say 85 or 90 miles an hour, I think it may make it more likely that we successfully, on a sustainable period of time, average inflation at 2%. What you don't want is stop go. And my only concern that I've raised is if you go too fast in the short run, it may make it more likely you have to take more action down the road. And I think stop go actually will make it harder to achieve the objectives of the new framework, which I strongly support.
Well, thank you, Jim. And of course, there's the issue of how forward-looking versus backward-looking one is when one is applying flexible average inflation targeting.
Yeah, the framework itself did have unanimous support on the committee, so I think it is an improvement on our approach to monetary policy in this very low interest rate, low inflation era. That era is not ending anytime soon. It looks like in Japan or in Europe. So we're going to be operating in that for a long time here. But what we've said is that we're going to be more tolerant when an inflation impulse comes along. And that's exactly what has happened, that we've got an inflationary impulse here, and we're going to be more patient with it. We're going to allow inflation to be above target for some time, and then we'll approach inflation from the high side and come back down to 2%. So actually, we got the chance to test the framework within the first year of it being in place. It didn't have to happen this way, but it did. And so this will give us a chance to flesh out a lot of these parameters. We did not say very much about, well, how far in the past would you look and how far in the future would you look when you're trying to average. But we did say that we would tolerate overshoot, and it does look like we're going to get an overshoot. And we will keep inflation under control, but not so much under control that we again drive inflation back down and get back into the situation that we were in for the last decade or so, where we kept missing our inflation target to the low side, and that eroded our credibility of our inflation target. So I think actually this is going very well. Sitting here today, this is going very well. But this is a volatile environment. We've got upside inflation risk here, and I agree with Rob that creating some optionality for the committee might be really useful here, and that'll be part of the taper debate going forward as we think about how much signaling are we doing about future rate policy with the taper program. And I've said last Friday that I'd welcome input from the private sector as well as to how we can execute this in a reasonable way, a smooth way as the pandemic comes to a close. We don't need the emergency policies anymore. Everyone knows that. But we want to do this in a way that is well telegraphed to markets, well ahead of time, and people understand how this fits in with the new framework.
Thank you. Well, the Fed is a proud independent central bank. It's served our nation well, and to that we owe, as a country, tremendous thanks to individuals such as yourselves, as well as the really strong, outstanding teams that back you up. As economists, you know that fiscal and monetary policy interact, and that monetary policy is less potent around the zero lower bound. Last year, Jay Powell went to great lengths to call for fiscal support. He got it. Some would say he got far more than he needed. So going forward, what fiscal policy would be most helpful to the FOMC in carrying out the fulfillment of its mandate? And a question I always like to ask people, do you worry about fiscal dominance weakening the Fed's control over its rate instruments at some point in the future? So Jim, start with you.
Yeah, I'd be happy to talk at length about fiscal policy. I think that the fiscal policy response to this pandemic actually was excellent. You got a bipartisan reaction in a divisive political environment in March and April. And I would describe the fiscal policy maybe a little bit differently than many. I would say that the pandemic came along and disrupted a lot of high physical contact workers. We immediately recognized that that's what would happen. We have to go to those workers and say, I'm very sorry, but you won't be able to do your job during this pandemic as we're trying to get the public health situation under control. But we also said, don't worry, we're going to do the very best that we can to provide insurance to you so that you're able to pay your rent, you're able to pay your monthly expenses, and you're able to maintain your lifestyles. We try to get this pandemic under control. That worked very well. The private sector households saved a lot of that, but I think that makes perfect sense because they weren't sure how long the pandemic was going to go on, and they weren't sure if Congress would reappropriate more funds later on. So all of this actually worked quite well. I was a little bit skeptical, for those of you that follow me, at the early part of the pandemic that the vaccine strategy would actually work, but lo and behold, fantastic results from the science community. Vaccines come online about a year ahead of time, and we got additional appropriation from Congress to continue to maintain this insurance aspect for the disrupted households. So if ever there was a time to borrow money on international markets and support your workers so that you don't do further damage to the economy while you're trying to deal with the pandemic, this is a beautiful response. And I would interpret that as, once every 100 years, something like this happens. We don't have anything written down in any law anywhere, but this is how we're going to respond. We're going to ensure the disrupted workers through that process, and we're going to maintain the integrity of the economy as we're going through the pandemic. So I think this was all very well done. Now, that leaves us with higher debt. But if ever there was a time to take on higher debt for a good purpose, this was it. And we're still in a low interest rate environment, and likely to be in one, broadly speaking, in the years to come. So I think all of that was good. Now, you've got this infrastructure debate going on Capitol Hill. I also think that's a good debate, because Congress should always be talking about the public capital stock. They should always be talking about, well, have we maintained the public capital stock appropriately? Are we doing the right things to support the longer term growth of the US economy? And they're talking about how to fund it. So this is something where, you're making the appropriate public, you can argue about the details of the debate, but you're talking about the appropriate level of public capital in the US economy, supported by the appropriate level of taxes as decided by the Congress. This is something that would play out over 10 to 15 years, because this is infrastructure. I don't see that as a near-term factor really for monetary policy, but I do see it as a medium and longer term factor for the long run growth prospects in the US economy. So I think that's a great debate to have as well. But to me, that's the infrastructure debate is over here. The pandemic response is something very different. And so those are just two different aspects of monetary policy, or I'm sorry, of fiscal policy.
Okay, well, thank you. I'll turn to Rob then. I hope that you can hone in perhaps a little bit on, given that we're coming out of the pandemic, and infrastructure is a longer term proposition, as a stabilization policy matter, where do you think it would be helpful for fiscal policy to head to help the FOMC's conduct of monetary policy in the coming years?
So as you know, we're always careful at the Fed. We're all always careful. I'm careful not to talk much about fiscal policy, in that it's another part of the government, and because of Fed independence, as I always say, we don't get to deal the cards, but we do have to play the cards. And on this, we play the cards that were dealt. Having said that, you saw something a little unusual from us, and I include myself, early in the pandemic. To Jim's point, it was up to us to call out, when you have a forced lockdown, there are limits to what monetary policy can do. And when you've got millions of people, through no fault of their own, who are unemployed, and there's no amount of monetary policy that's going to rectify that. And so a number of us were vocal in calling that out, and talking about the need for fiscal policy, particularly unemployment benefits and other actions that could protect those and sustain those who are going to have a hard time making ends meet because of the pandemic, and small businesses and businesses generally that needed access to capital, either through PPP or stabilizing the financial markets. So in that regard, yes, we did comment on it. I think beyond that, I would probably stay away from the size and the magnitude of what's going on in fiscal policy. I would comment, and I have commented though, on infrastructure spending, and just to point out, it's of character different than other types of fiscal spending that supports consumption. Fiscal policy that supports infrastructure, as Jim said, is a long-term investment. It could help improve productivity. It could help improve sustainable GDP growth. And so it's of a different character. And I think that's worth mentioning. I do think, and I've talked about pre-pandemic, I talked about the fact we did a lot of work at the Dallas Fed saying that the path of US government debt to GDP was likely not sustainable. I said that in January of 2020. We're now gone from 77% debt held by the public to approximately 100%. and the present value of unfunded entitlements is 65 trillion and growing. And the only reason the US is able to manage this is the dollar is the world's reserve currency. I hope that will continue for a long time, but I think it would be wise not to rely on that presumption to last indefinitely or so heavily. And so I'm sure there's going to be a lot of tough discussions. How do we grow faster, which is part of the puzzle? How do we moderate our spending growth? And that includes a lot of touchy issues about entitlement reform, generating revenues. But I think that discussion is probably going to be necessary. I think our job as central bankers at the Fed is to understand these proposals, and when they're enacted, to adapt monetary policy accordingly.
Okay, well, I'm getting mindful over timing, but just on the, if I can get a 15-second answer out of Jim on fiscal dominance. I think I've heard you in the past say, the Fed's independent, you're not worried about it, but it's something that the Fed should keep an eye out, that we should be mindful of. Is that a decent characterization?
Yeah, I'm not worried about fiscal dominance. I think we're an independent central bank and we'll continue to be independent.
Great. Okay. On top of your dual mandate, the Fed has important financial stability responsibilities. So many analysts see significant froth in U.S. markets. They point to equity, housing we've discussed, there's spread compressions, there's Archegos and that episode. To separate monetary policy from financial stability concerns, it's argued strong micro and macroprudential oversight are needed. The banks have weathered the storm well, it seems, but non-banks often pose huge risks, which can hit the FOMC's ability to meet its dual mandate, and yet they're outside the Fed's remit. So how concerned are you about froth? And then how concerned are you about financial stability risks, particularly if they're emanating from outside the Fed's remit, and what should be done? Rob, please.
Yeah, so I've talked about the fact when you have very accommodative monetary policy, as we've needed to have due to the pandemic, and you've got this level of asset purchases and liquidity being injected in the system, one of the side effects you have to recognize, and I think we're wise to acknowledge it, has a material effect on financial assets. And I do worry, and I've said this consistently, I do worry about excess risk-taking in non-bank financials, which looks benign while it's going on, but when you notice it is when people need to de-risk. And so when you have this level of actions that we're taking, I think it does encourage people to go out the risk curve, and I think that is what's happening. As you said, not only do we not have jurisdiction over non-bank financials, I don't think we have great transparency on what's going on in non-bank financials. And some recent events have sort of demonstrated that. I think you tend to learn about some of these excesses after the fact. There's debt and margin debt, which you can see. It's harder to see derivatives and use of those, which is another form of debt. And so I think it's wise to, I'm not worried that this is going to create undue financial instability, but I do worry about this amount of risk taking. If you get to a period where there's a de-risking, even a modest de-risking, and when you have intermediation not quite able to manage it, you can have a severe tightening abruptly in financial conditions. I think we should be worried about that and cognizant of it. And that's one other reason why, if we can find our way clear sooner rather than later to start making some adjustment to these asset purchases, I think would be far healthier. And Mark, you may have frozen a little bit here.
He's frozen on my screen too, so.
Okay, I don't know if you got the end of that, Mark. Yes.
I more or less, but I've just come unfrozen. Jim, please, do you have any thoughts on this?
Well, I think that the FOMC has made a lot of changes since the global financial crisis. We have much better radar, much better intelligence on trying to track excesses in financial markets, trying to pin down more tightly what we mean by froth in particular markets, concepts of fair value or equilibrium in various places in financial markets, watching, I think, much more closely developments as they occur, new innovations as they happen in financial markets. I also think we benefit from very much from having Rob and others on the committee that have direct experience in financial markets because macroeconomist view of these things like I would have is, our models are not very good at tracing these kinds of things. And so I think this is a place where direct experience really plays an important role. And so I think we're doing the best we can on this. I think we are in a situation where we could possibly see bubbles develop, and possibly they're developing today. That's something that we can continue to debate. This has been a debate that has been going on ever since the irrational exuberance speech in 1996. And I don't think the central bank has really come to a very good answer to it after all that time. But I think the good news is that our radar is quite a bit better than it would have been before the global financial crisis. And the FOMC does get regular briefings on this and does regularly comment on this. So I think that's a good sign for the future.
Okay, well, thank you for that. And I agree that the Fed does a much better job on financial stability, and I like your reports. I think that's a wonderful innovation. So I congratulate you and the FOMC on that. Okay, we're running out of time. Let me just ask maybe one or two more quick questions. The FOMC just announced it would conduct overnight reverse repo operations at 5 basis points. This was portrayed as a largely technical matter and providing a floor for money market rates. As I mentioned earlier, Steve Cicchetti at an OMFIF event characterized this as a giveaway to money market funds on top of the Fed's efforts to sustain the money market fund model in 2008 and 2020. And Zoltan Pozar, who's a Credit Suisse analyst, who's one of the best on financial market plumbing, basically said 5 basis points was too generous and would cause huge shifts from treasuries to parking cash at the reverse repo facility. I think a few people have asked that from the audience. Do either of you want to offer a quick thought on this? Should I start with Rob, since you have a good background in markets?
Yeah. It's intended as a largely technical matter. I think these issues that others have raised is something we need to monitor very carefully.
Yeah, I would say, our focus is on control of the policy rate, which is the federal funds rate. And these are technical adjustments driven by the New York desk on what has to be done in order to maintain control over the short-term end of the market.
Maybe a last provocative question then. The Fed anchors the short end of the market, not the long end. And yet, here we've had massive fiscal stimulus, and the inflation outlook is changing substantially. And yet the 10 years sitting at the 1.4 today. Is this at, do you have any thoughts for us? Obviously difficult subject, but is it Fed credibility, don't fight the Fed, or is this just Fed purchases and the Treasury cash management practices at this time? Do you have any thoughts or insights for us? Start with Jim this time.
Okay.
I think markets themselves are a little bit confused about the recent moves. I do think we're going to allow inflation to be above target, as I've been stressing here. So that has to get priced in. But in addition, you still got very low rates in Europe and Japan. I just don't see how U.S. rates can go too much higher than where they are in Europe and Japan. And that's, in my opinion, I've always stressed that that's what's capping U.S. rates and what prevented them from going to 2% earlier. So, I mean, there are a lot of factors in this market, so no one really knows exactly how these trades are occurring. But that would be my overall impression.
Rob.
So I just build on what Jim said, because I agree with it. There are 3 or 4 factors going on. Yes, the Fed purchases has some effect on the one side. On the other hand, if you get out over the horizon, we have an aging society, workforce growth is decelerating. I think people in the bond market are very aware of that over the horizon, unless we improve productivity to offset slowing workforce growth, we're going to have sluggish GDP growth, not just in the United States, but globally. And yes, US rates are relatively speaking lower than many other parts of the world. And there's an enormous amount of pension fund money and global money available that wants to own the 10-year treasury and be in the dollar. And so there's a whole range of factors and cross currents that make this a very complex thing. But there's a strong bid for the U.S. Treasury, and I think there will be for an extended period of time. Maybe at somewhat higher rates, but there's a strong bid for the U.S. Treasury.
Well, thank you for that. Well, the two of you have spent a bit over an hour with me. That's more than many people can tolerate. So I want to let you get to your day jobs. So I want to thank Robert Kaplan and Jim Bullard for a wonderful discussion today. I know I greatly benefited from it. I'm sure the audience did so as well. I also thank the audience for joining us. And then last but not least, tomorrow, OMFIS Fed Week will continue with a discussion on the economics of artificial intelligence and machine learning by leading experts, including from the Philadelphia Federal Reserve. Until then, we'll see you tomorrow. And once again, thank you to Jim Bullard and Rob Kaplan. This was wonderful.
Thank you.
Thanks very much, Mark. Great to see you.
Pleasure. Thank you.
Bye-bye.